Buenas tardes, bienvenidos una vez más a Casting Studies. Todo este lío de cascos, cables y cosas que veis por aquí hoy tienen un motivo, y el motivo es que estamos entrevistando a una de esas personas que siempre hemos soñado con entrevistar. Es Jesse Felder, aparece en casi todas nuestras webs, es uno de esos inversores que siempre hemos seguido y hoy estamos súper contentos de poder entrevistarle. Para el que no le conozca, Jesse Felder es uno de esos grandes gestores de hedge fund en Estados Unidos. Estuvo gestionando uno de estos grandes hedge funds con muchísimo éxito hasta que se lo dejó, luego nos contará por qué, y empezó a hacer lo que hoy hace, que es The Felder Report, y es uno de los grandes research sobre inversión que puedes encontrar en Estados Unidos. Thank you, Jesse. We are totally glad that you are with us today. We want to talk with you, not just for this interview, but for hours, about investing and about your career. And the thing that I would like to start with is that you were managing a multi-billion-dollar hedge fund. How was this time in your career, and why did you left this job?
It's a good question. I was that would have been the late 1990s after I left Bear Stearns, and I was actually the co-portfolio manager. I had a partner at the firm. I was the head trader, and the reason I left was really I guess it was twofold. It was kind of a difference of opinion with my partner. We had a mandate, a value mandate, which was very difficult to adhere to for some people during the dot-com mania in the late 1990s. And value stocks were very out of favor, very much as they are today, and even to a greater extent because so many people were focused on the new economy and the dot-com stocks and that sort of thing, that they really left a lot of these old economy stocks, as they were called at the time. They left them for dead. There were just so many great companies that were so cheap at the time. And I was finding terrific opportunities to invest in some of these names. And my partner wanted to focus more on, buying the red hats and the real high flyers during the time. And I kind of felt like that was not really within our mandate and didn't fit the fund very well. Although it was working at the time from a momentum standpoint, it was not what we really told investors we were going to be doing with the fund. And so we would get in arguments on a regular basis over how that the funds should be allocated in that respect. And I also, had a different sense of I guess ethics is the way to put it, is that he really wanted to kind of push the envelope, and he told me this straight up, of he didn't care what was ethical, wanted to push the envelope of what was legal. And to me, that made me very uncomfortable.
Yeah,
I can bet. That was really my main reason for leaving the fund. And it was only about 10 years. I left in March of 2000, the peak of the dot-com mania, by chance, really. I wasn't a market timing call or anything, but it was literally within a week or two of the NASDAQ peaking in 2000. And 10 years later, he and the three of us were kind of the founding partners. Sued each other, and the SEC sued the firm, and the whole thing kind of came crashing down. So, as in many things in investing, I was way early, but I got out at a good time, I think.
Yeah, I can bet. Anyways, Jesse, after that, you founded the Felder Report. I'm subscribed to your report. It's awesome, I have to say it. And you've been spreading the word about finance and about your charts, about your point of views in regard to the market. And in my case, I have a question that is, many often I've heard that you use a fundamental basis to analyze companies, but then at a time you blend that with macro and with technical analysis. I have no idea about technical analysis, but I'd like to know a little bit about your the way you manage the analysis in your case.
Yeah, for sure. So it is a value. You know, I started out as a value investor and a huge fan of Warren Buffett's work, and I really believe that for most investors, maybe the best education you can get in terms of value investing is just reading Warren Buffett's letters to shareholders at BerkshireHathaway.com. I mean, there's decades of wisdom and him describing his process through that, through his career. And I think that's extremely valuable. And to me, the margin of safety concept, when I first heard about it, just resonated with me. The idea that if you try and buy, something worth $1 for 50 cents, not only are you protecting your downside, you're building in that margin of safety. Whether if your analysis turns out wrong and it turns out the thing you thought was worth $1 is really only worth 50 cents. Well, how much did you risk if you paid 50 cents for it? You're really limiting your risk, but you're also you're really opening up much more potential upside from the fact that if it does turn out to be worth $1, you're going to make 100% return when the market eventually realizes this before you even begin to keep pace with the economic value of the business growing over time. So, that's always been kind of the foundation of my process. But I think it was about 15 years ago, I started paying close attention to technicals. I met Todd Harrison through Minionville, and he introduced me to Tom DeMark, who has done some fascinating work in terms of looking for reversals. And when you start studying technicals, to me, it's trying to understand momentum in the markets. I think is really what technicals help to do, is give you a visual picture of momentum. And when momentum is really strong, either to the upside or the downside, that trend usually persists in that direction for a time. And so as a value investor, that was kind of an important wake-up call for me, that I can find something that's cheap, but if it has really strong downside momentum, it's probably going to continue in that direction for a time. And I'm better off waiting until that momentum begins to show signs of slowing and the market beginning to show me signs that people are really beginning to appreciate this value. So from a timing standpoint, adding some technicals has been extremely valuable in avoiding things that prove to be value traps because they have really strong downside momentum, or in looking for things that I do believe offer good value, but also allowing the market to tell me when it's time, when that value is going to be recognized. So that's really I guess the idea.
It reminds me a little about the Stanley Druckenmiller approach, actually, that blending those ideas, So it's and also reminds me when in the episode that you had with the TIP guys, when that kind of approach helped Stig Brodersen to avoid that. I think it was Bed Bath & Beyond. I think that stock. Yeah, it's awesome.
Yeah, and it was interesting because I talked with those guys on their podcast about Bed Bath & Beyond when Stig recommended it as an interesting value idea. But that was, kind of my point to him at the time, was that this stock has really strong downside momentum, and I wouldn't want to step in front of it. And then just, several months ago, I went back on the show to say, no, I think it's time to buy Bed Bath & Beyond.
Exactly.
Because the longer term standpoint, you have those technicals that are, first of all, the stock got incredibly cheap. So you have the real incredible value there. And then you have the market started to tell you there's potentially a floor, the stock's potentially basing.
Yeah.
And so to me, that's, a good example of me trying to use that as a timing tool.
I want to bring here back the thing that you were saying about this 2000 moment when the internet and the value stocks, they were in a totally different situation, and they were a great momentum for internet, but they were very expensive stocks, but value was depreciated, And today we have kind of similar situation with the funds and with the momentum versus value, spread. And you can see this kind of charts everywhere talking about the value is not the people don't want value, and they say that we have similar situation like 2000. How do you see that point today? Because today we are similar. How do you feel that? And how do you feel that the passive investment has influenced this kind of situation?
Yeah, it's a great question because it really is a very interesting time again today. And there are parts of it that do remind me of that 2000 peak in the markets. Back then, I'll say that some of the value that I was finding, it was almost unbelievable how cheap some of these stocks were getting. One example was a company called Washington Mutual, which was essentially a very big thrift. So they would basically take in deposits, very simple banking model. They would take in deposits, loan it out into mortgages, and keep the spread. And they were one of the larger banks that was kind of basically just still pursuing that very simple banking model and hadn't got into all the other types of banking that a lot of the other banks do today. And that stock was trading at 5 times earnings in 2000. Yeah. And that's what happens with financials a lot, where we had the yield curve was inverted back in 2000, just like it is today or was recently. And so financials, net interest spreads get squeezed. But I mean, when you have a stock that's trading 5 times earnings on probably bottom of cycle earnings for a company like that, the narrowest possible spreads that they could have, that, once the yield curve starts, widening again, their earnings are going to go nuts, and the valuation too. So I think Washington Mutual in 2001, 2002, the stock, value stocks generally, but I think Washington Mutual went up 100, 200% in just a couple of years' time. And I was just kind of astounded how many different opportunities like that I was seeing in the market, in stocks that, like I said, these old economy stocks that nobody wanted to own because the pets.coms and all those kinds of things were so popular. Today, a stock like Bed Bath & Beyond is a good example where, this company was worth tens of billions of dollars just a couple of years ago. And very recently, it was trading at $1 billion market cap. And for that reason, it's fallen out of all the big indexes. And there's just no interest. I think a lot of money has been pulled out of, I think, your point about passive investing is a good one. That's the dynamic back then, was that people just wanted to own the growth stocks, didn't want to own value. But in a different respect, we're seeing the same dynamic today, but it's not explicitly, I want to go buy growth stocks. But when you are buying a passive index, you're putting more money into those stocks that are the most popular stocks in the market. So it's more of a systematic or quantitative way that people are preferring growth stocks over value today. And so much money has come out of actively managed funds that value as a discipline has suffered from withdrawals for years and years now. So there's really no money going into these kinds of stocks. Yes, there are value indexes and things, but even these are out of favor. So there are a lot of similarities. I will say the one difference between then and now is that yes, the disparity between growth and value is wide, but I'm not seeing the breadth of value opportunities as I was back then. I think today the breadth of the overvaluation in the market is much greater than it was back then. You look back then, it was really just some of the most popular stocks in the market, these .com stocks. You had Coca-Cola and McDonald's, and other things got really expensive too, kind of almost a nifty 50 type of thing that happened in 2000. But today, the breadth of overvaluation in the market is greater than anything we've ever seen. So even the cheapest decile of the market trades at its highest valuation in history. So, and you can see that, and it's not just all the popular growth stocks. You have utility stocks trading at their highest valuations in history, real estate stocks, highest valuations in history. So that's the one difference I would say between today and back then, is that we have this breadth of overvaluation today that's much greater than it was back then.
Do you think that this passive investment and this no choosing which stock I'm investing because I'm buying just the Nasdaq, or the SP 500. So no one is choosing stocks, or very few people or less people day by day is choosing which stock to invest with. It's gonna kill in one way or another the value investment, or in the other hand is creating new opportunities for value investors, because there is a controversial here about some people that say one thing, some people say other thing, and maybe it's only a matter of momentum, as you were saying. But when is this momentum gonna come for value investment? I don't know.
Well, yeah, it's a great question. I think we're seeing signs of a shift right now, where value, I mean, a stock like we talked about, Bed Bath & Beyond, is up 100% off its lows just a month or so ago, 2 months ago. So we've seen this like a momentum crash in the last month, and value make a massive resurgence. But to your point about passive and the death of value investing, or the death of active investing, whenever the media declares the death of something, I always pay attention. They back in 2015, they were talking about the death of gold, and gold is never going to be a great investment ever again, and that turned out late 2015 to be the best time to buy gold in over a decade. So to me, it's very exciting that a lot of media, I think even the Wall Street Journal over the weekend had a big article about how stock pickers, it's the twilight of stock picking. Essentially, we're very near the end of stock picking, the death of stock picking. That to me is very exciting from a contrarian standpoint, because with so much money going to passive, it does create, I think, terrific opportunities for investors to look outside the indexes for these stocks that have been left for dead. And Warren Buffett, one of my favorite Buffett quotes, is from the 1985 Berkshire Hathaway letter to shareholders, said, "What could be more advantageous in an intellectual contest, whether it be bridge, chess, or stock selection, than to have opponents who have been taught that thinking is a waste of energy?" And that's essentially what everybody in the market is doing today by going passive, is they're essentially been led to believe that thinking in the markets is a waste of energy. And so now that we see more than 50% of the funds in the markets, at least hedge funds, mutual funds, ETFs, are now being managed passively, they've all given up on the idea that thinking in the markets can actually do well for them. That creates, I think, terrific opportunity for those of us that do want to put our abilities in thinking and stuff to work to actually find value.
Yeah. I have a question also, because you were mentioning about if we are facing a passive investing, or the market is maybe this is other way to put it. If the market is having kind of a bubble because of this situation, because of the passive investing, the money through the funds, the mutual funds, the ETFs, and etc. So it could blow up the bubble. So do you face that, and would you use other type of asset as shelter? Maybe gold or something like that. I don't know.
Yeah. No, I have been bullish on gold since 2015, and I do think it makes sense, to have a certain allocation to gold at all times. But I think it makes especially good sense today because of what's going on in terms of the fiscal situation around the world, but mostly in the United States. I'm mostly concerned about the fiscal situation. Usually when we see the federal deficit blow out like it's doing right now, it's bad news for the dollar. I do think it worries me that our government here on both sides of the aisle, Democrats and Republicans, are both coming around to the idea that they don't need to worry about how much debt they're creating. That this idea of we needed to have some sense of fiscal austerity to protect the debt from getting out of control has just gone away. That now there's this idea that, and it's because interest rates have stayed so low for so long, it's given them this idea that, hey, maybe the debt isn't too big and we can create a bunch more debt. So we have $1 trillion annual deficit, which is close to 5% GDP, and that's growing. And to me, that's typically bad news for the currency. And so that could prove to be inflationary over a period of time too. And so I definitely want to have an allocation to gold and an oversized allocation right now, even though in the short run, I do think gold could continue to correct for a little bit. I'm very bullish over the longer run. I think that's one way that investors can kind of protect against overvalued assets and stocks and bonds and whatnot. I think the other way is there's a better way to index. And I think you can, rather than using a market cap weighted index or a market cap weighted, actually float adjusted market cap based index, which I think a lot of people don't understand, that float component is a big deal. That you can use a fundamental index that, Research Affiliates, Rob Arnott's firm, created a new way of indexing that I think is brilliant. It focuses on ranking companies based on the economic value they create rather than how popular they are in the markets. And so it's, sales and book value and these types of things that companies are ranked by. And I think if value is going to make a comeback and you focus on an index like this, you'd be much more protected than by focusing on an index that is most heavily weighted to the most overvalued stocks in the market.
Very interesting.
Hey, you say one thing that I totally agree with you. That is, the index could be a bubble in index investment, like we know it today. But there is another way of evolve of the index investment, and is this the way that you are saying? Creating new ETFs, creating new indices. You can see this in United States. Toby Carlyle, that is going to be with us next month here in Spain, has created a new ETF based on value investment, as you are saying, and another kind of ETFs that can help you to invest in another way could be a great thing. But my question for you is, the last time that we saw the situation that we have right now in terms of current, in terms of rates and Federal Reserve and zero rates and so much debt, was in the 30s in the United States, and the end of that was this 70s big inflation and no growth that we saw in the economy. Do you think that we are going to face this big inflation and no growth in the economy at the end of this period of interest rates in zero?
Yeah, I think we already could have entered a stagflationary environment with very low growth and rising inflation. You look at wage inflation in the United States right now, it's the highest it's been in 20 plus years. So we're told there's no inflation, but when you look at core inflation, core CPI, sticky CPI, some of these measures, they're all running well north of 2% inflation. And so I think we're starting to see and there's two different dynamics at work here. There's late cycle stuff, which is the wage inflation, but I think there's also some secular dynamics too that are at work. And to me, that would be this move towards deglobalization, I think is a very important inflationary dynamic that a lot of people aren't paying close attention to. Of course, they understand the trade wars are one dynamic of that, and tariffs are inflationary, or actually stagflationary, right? Because they raise prices, make it more difficult. People have to cut back their spending, but prices are rising at the same time. But the trade war is just one kind of, I think, symptom of this larger trend towards deglobalization. And when you think about what was the most disinflationary dynamic of the last 30 plus years, was probably this move towards globalization that allowed companies to offshore labor, dramatically reduce their costs, keep labor's share of income lower and actually lower over time. So to the extent that globalization trend reverses, and we start seeing reshoring of labor, reshoring of jobs and manufacturing and whatnot, that is an inflationary trend. And so I think what we're seeing right now is, yes, very slow growth in the United States and around the world. I think GDP for the rest of the year is supposed to come in 1.5, 1.4, something like that, even maybe lower next year if we avoid recession. And at the same time, I think we're seeing these rising costs. The parallel to the 70s, I think, the interesting one that I saw in the Wall Street Journal maybe a month ago, was that if all the tariffs are implemented, the ones that proposed, it would have the same economic impact as the oil crisis did in the 1970s. It'd be almost a direct parallel there. So I think people are not, they see the slow growth side of the equation, but I think so many people believe inflation will never come back again. And this is another one of those things where The Economist and Business Week have both declared the death of inflation in the past year. To me, that is another just, contrarian sign that inflation's about to make a big comeback.
It sounds to me a little like the Japanese, Japanese approach, no? It's do you think that we are facing kind of a, not only in the States, because in Europe we also see something like that, like we are kind of, bringing the Japanese approach, and I'm not sure actually how it is going to work, How do you think?
Yeah, I think the difference, between Japan and the rest of the world is it's important to note that we're looking at a 5% federal deficit right now outside of recession. When you look at the United States, and this goes back to the 70s again, my friend John Hussman has done some interesting work here. The only other time you've seen the federal deficit widen during an economic expansion was in the 60s and 70s, early 70s. And that's what leads people to start losing faith in the currency, is when you see this fiscal profligacy going on in the midst of an economic expansion. Yeah, everybody expects the deficit to widen during a recession when revenues tumble and that sort of thing, and then there's usually fiscal stimulus. But when you see the deficit widening, and back in the 60s and 70s, only widened to like 2.5% of GDP. We're 5% of GDP today. So it really comes back to, are people going to start losing faith in the currency?
Yeah.
If people start losing faith in the dollar, and that causes another dollar bear market, that will be inflationary. So there, the other side of it too is Japan is unique in terms of demographics. I think it was the BIS did a study a couple of years ago that showed, demographics, the age dependency ratio. So when you have a great aging population, that has been actually disinflationary in Japan, where everywhere else around the world, it has been correlated to inflation. So you have, in the United States, this age dependency ratio has been very correlated to inflation. We have this aging population, and these people are going to start pulling money out of investments and spending very heavily on end-of-life type of things. Here in the United States, healthcare is one of the most expensive things we spend money on. And so if these people start, spending tons of money on end-of-life stuff, that is a huge spending boom that could, and especially in the context of younger generation, that we don't have the people to provide the medical services. Nursing is one of the areas where we're seeing wages go through the roof here in the United States. So I think the Japan, parallel kind of runs into some of these roadblocks when you try and bring it to the United States.
Okay, Jesse, thank you very much for all this talking. I'm going to ask you just the last question. I'm going to ask you first that I won't have another conversation with you
Totally.
next month, or if it's possible, every month. I'm totally excited about the talking that we are having. So
Yes,
my first question is, please be with us another time.
It would be my pleasure. This has been a blast, so I'll be happy to.
Thank you.
My last question for you is, okay, if you have to create a portfolio today, which part of this portfolio would be in stocks? Which part would be in gold? Which part would be in other stuff?
Yeah, it's a great question. I think if I had to invest in the market cap float adjusted weight index, I'd have a 0% allocation to U.S. stocks today.
0%.
I personally like the fundamental indexes. I think if I'm using the fundamental indexes that were going to expose me to value within these different markets, I'm going to be overweight emerging markets today because I think that's where the real value is around the world. I'll have probably an underweight allocation to, or maybe an equal weight allocation to European equities, because I think there's some real value in Europe right now. And I'd still be underweight U.S. equities because we are as overvalued as we've ever been in this country. But I would want probably some type of an allocation to take advantage of value in U.S. equities. Fixed income, on the fixed income side, I want to stay, very close to the short end of the curve. I don't want to own long-term bonds if I think the dollar may be in trouble, if inflation's potentially coming. I think bonds are as overvalued as stocks, if not more so. And I don't want to own any corporate debt today because of the massive leverage on corporate America's balance sheets.
Absolutely.
So really the only thing I'd be overweight today would be precious metals. I'd probably have an equal weight, weighting towards real estate investment trusts in the United States. And I'd want to have a value bent there too. But I think real estate in an inflationary environment does pretty well.
Yeah.
But I think the only thing I'd be overweight today in is gold.
That's
Thank you very much for your time. Thank you very much for your talking.
It's been a pleasure to have you on, man.
It has been a pleasure.
Thanks for having me, guys. It was a lot of fun.
Thank you.
Thanks, Jesse. Bueno, pues hasta aquí un día más de Casting Strategies. Esperamos contar con Jesse Felder no una vez, sino
Otras muchas, ojalá.
veces más en Casting Strategies. No olvidéis suscribiros al canal si os ha gustado y nos vemos en próximos vídeos. Muchas gracias.